Think your 401k is just a simple savings account? Think again. There's a lot happening behind the scenes that most people never see. For example, did you know about vesting schedules? That means you might have to work a certain number of years before your employer's matching contributions are truly yours. And what about fees? Even a small percentage can eat away tens of thousands of dollars from your retirement nest egg over time. It's crucial to understand what you're invested in, from target date funds to index funds, as each has different risks and potential returns. Don't just set it and forget it. Taking a closer look at your 401k's hidden dynamics can make a massive difference in your financial future. Want to learn more ways to maximize your retirement savings? Hit that subscribe button and let's get smart about money together. While you were following the conventional advice to contribute consistently and not check your balance, something important may have escaped your attention. Your 401k isn't a simple savings account. It's a complex investment vehicle with features, limitations, and dynamics that significantly impact your retirement outcome. The investment options available to you, the fees buried in plan documents, the rebalancing mechanics, the timing of contributions, the tax implications of different choices, the relationship between your investments and broader economic events. Each of these factors affects your retirement wealth. Yet most 401k holders couldn't accurately describe how any of them work. According to various surveys, a significant percentage of 401k participants don't know what fees they're paying. Many can't name the funds in their portfolio. Most have never read their plan's summary document. This isn't criticism, it's recognition of reality. The 401k system wasn't designed to be easily understood, but your retirement depends on it regardless. The gap between what you know and what affects your savings represents risk. Understanding that gap is the first step toward closing it. Now, let me be absolutely clear before we continue. I'm not a financial advisor, registered investment advisor, or licensed professional. Nothing in this video constitutes investment advice or a recommendation to take any specific action with your retirement accounts. What I'm presenting is educational information about 401k mechanics, drawing from Department of Labor regulations, IRS publications, academic research on retirement savings, and publicly available data from sources like the Investment Company Institute and Employee Benefit Research Institute. Your specific situation requires consultation with qualified professionals who understand your complete financial picture. I'm not telling you what to do. I'm sharing information about how 401k accounts work that many participants don't understand. What you do with this information is your decision to make with appropriate professional guidance. By the end of this video, you'll understand dynamics of your 401k that most participants never consider, how economic events can influence retirement account values, and questions you should be asking about your own plan. Because here's what most people don't realize. The set it and forget it advice, while generally sound for long-term investing, has led many participants to disengage completely from understanding their accounts. There's a framework here, a framework for understanding what's actually happening in your retirement account, for recognizing when major economic events might influence your holdings, for asking informed questions of plan administrators and financial professionals. Same account, same contributions, different understanding. The gap between passive participation and informed participation can be significant over a career of saving. The only question is whether you'll understand these dynamics while you still have decades to benefit from that understanding, or whether you'll discover them only when retirement arrives. Stay with me. The next 15 minutes will illuminate aspects of your retirement account that deserve your attention. To understand your 401k more deeply, you need to understand the 5 critical dynamics that most participants never consider. Dynamic 1. The fee structure. Your 401k has multiple layers of fees. Plan administration fees, investment management fees, individual fund expense ratios, transaction fees in some plans. According to Department of Labor data, 401k fees typically range from 0.5% to 2% of assets annually, though some plans fall outside this range. The difference between a 0.5% fee and a 2% fee, compounded over a 40-year career, can represent hundreds of thousands of dollars in retirement wealth. Same contributions, same returns before fees, dramatically different outcomes. Yet many participants have never calculated their total fee burden. Dynamic 2, the investment options. Your 401k offers a limited menu of investment options selected by your plan administrator. These options may or may not be optimal for your situation. Some plans offer excellent low-cost index funds. Others feature higher-cost actively managed funds. Some include company stock options with concentrated risk. The options available to you constrain your choices. Understanding what's available and what's not matters for your retirement outcome. Dynamic 3, the target date mechanism. Many 401k participants use target date funds, which automatically adjust asset allocation as retirement approaches. These funds are convenient but not identical across providers. A 2045 target date fund from one provider may have very different allocations than a 2045 fund from another. The glide path toward retirement varies significantly. If you're in a target date fund, understanding its specific methodology matters for your planning. Dynamic 4, the economic sensitivity. Your 401k investments respond to economic events, Federal Reserve decisions, inflation data, employment reports, corporate earnings, geopolitical developments. These events affect your retirement savings whether you follow them or not. Understanding the basic relationships helps you interpret your account statements and maintain perspective during volatility. Dynamic 5, the timing dynamics. When you contribute matters. When you might need to withdraw matters. Market conditions during specific windows can significantly impact outcomes. The sequence of returns risk, particularly near retirement, represents one of the most significant threats to retirement security that many participants don't understand. Now let me show you 3 examples of how these dynamics have historically affected 401k participants. 2000 to 2002, the dot-com crash, and 401k participants. This example matters because it demonstrates how economic events affect retirement savings and how participant behavior during volatility influences outcomes. In the late 1990s, many 401k participants became heavily concentrated in technology investments. The market was rising. Tech funds showed the best returns. Participants shifted allocations toward what was working. By 2000, many participants held significant technology exposure, either directly or through growth funds heavily weighted toward tech stocks. Then the bubble burst. The Nasdaq Composite declined approximately 78% from peak to trough. Participants with tech-heavy allocations saw devastating losses. 401k balances that had seemed to promise comfortable retirements shrank dramatically. But the story doesn't end with the decline. It continues with behavior during the decline. Research on 401k participant behavior during 2000-2002 revealed patterns that amplified losses. Many participants sold equity holdings after significant declines, locking in losses. Many then remained in conservative allocations, missing the subsequent recovery. The participants who suffered worst weren't necessarily those who experienced the initial decline. They were those who changed their behavior at the wrong moments. The lesson isn't about predicting crashes. It's about understanding that economic events affect your 401k, and that your behavior during volatility matters as much as the volatility itself. Pattern established. Economic events affect retirement savings. Participant behavior during events can amplify or mitigate impact. 2008 to 2009, the financial crisis and retirement accounts. This example matters because it represents the most severe test of 401k accounts in modern history and reveals dynamics every participant should understand. The 2008 financial crisis caused broad market declines exceeding 50% from peak to trough for major indices. 401k balances fell correspondingly for participants with equity exposure. According to data from the Employee Benefit Research Institute, average 401k balances declined by approximately 27% during 2008 for participants with significant tenure and equity allocation. But the crisis revealed several important dynamics. First, concentration risk materialized. Participants heavily invested in company stock, particularly at firms that struggled or failed, faced devastating outcomes. Enron and WorldCom had already demonstrated this risk in 2001, 2002, but many participants hadn't learned. Second, age-based vulnerability became clear. Participants near retirement faced sequence of returns risk at the worst possible moment. Those who needed to begin withdrawals during the trough faced permanent impairment of retirement security. Third, behavioral patterns repeated. Research showed that many participants reduced equity exposure after major declines, again locking in losses and missing recovery. Fourth, fee awareness increased. During the crisis, participants paying higher fees saw those fees continue regardless of performance. A 2% fee on a declining portfolio still extracts value. The participants who fared best shared common characteristics. They maintained diversification. They continued contributing through the decline. They didn't panic into cash at the trough. They understood that long-term investing involves volatility. The lesson, understanding your 401k's risk characteristics before crisis arrives, enables better decisions during crisis, the pandemic crash and recovery. This example matters because it's recent. Many current participants experienced it directly, and it demonstrated both the speed of modern market movements and the importance of maintaining perspective. In March 2020, markets declined approximately 34% in roughly 1 month. The speed was historically unusual. 401k participants saw balances drop rapidly. Then remarkably, markets recovered. By August 2020, major indices had regained their pre-pandemic peaks. The round trip from peak to trough to peak occurred in approximately 5 months. This episode demonstrated several dynamics. First, the speed of modern markets. Information travels instantaneously. Algorithmic trading amplifies moves. Declines and recoveries can occur faster than participants can reasonably react. Second, the futility of timing. Participants who panicked into cash in March faced a difficult decision about when to return. Many waited for confirmation that the worst was over. By the time they felt confident, significant recovery had occurred. Third, the importance of contribution continuation. Participants who maintained contributions through March 2020 purchased shares at significantly reduced prices. Those purchases subsequently appreciated substantially. Fourth, the variation in recovery. While broad indices recovered quickly, not all investments did. Some sectors lagged. Some individual holdings never recovered. Diversification mattered. The lesson? Modern markets can move faster than human decision-making. Having a framework in advance serves better than reacting in real time. 3 episodes, 3 different market environments, consistent lessons about 401k participation and the value of understanding your account. Now let me show you how to apply these lessons to your current 401k situation. Step 1. Know what you own. This sounds basic, but many participants can't accurately describe their holdings. Log into your account, identify each investment option, understand what each holds. If you're in a target date fund, research its specific glide path and underlying holdings. If you have a diversified allocation, understand the breakdown between stocks, bonds, and other assets. Knowledge of your actual holdings is foundational to informed participation. Step 2. Understand your fee burden. Calculate your total annual fees. This requires examining both plan-level fees and fund-level expense ratios. If your plan charges 1% in administrative fees and your average fund expense ratio is 0.75%, you're paying 1.75% annually. On a $100,000 balance, that's $1,750 per year in fees. Compare your fees to alternatives. Low-cost index funds in the broader market often have expense ratios below 0.1%. If your plan offers similar options, they may be worth considering. If your plan only offers high-cost options, understanding this limitation matters for your overall planning. Step 3. Assess your risk profile. Does your current allocation match your time horizon and risk tolerance? Many participants are either more aggressive or more conservative than they realize. If you're decades from retirement, historical data suggests that equity exposure has provided higher long-term returns despite volatility. If you're near retirement, sequence risk becomes more relevant and allocation may warrant review. This isn't advice about what allocation you should have. It's encouragement to consciously choose your allocation rather than defaulting into whatever your plan initially assigned. Step 4. Understand economic sensitivity. Your 401k responds to economic events. Learn the basic relationships. Generally, interest rate increases have historically pressured bond prices. Economic strength has typically supported equity prices, while recession fears have often pressured them. Inflation can affect both stocks and bonds in complex ways. Understanding these general relationships helps you interpret account fluctuations without panic. Step 5. Consider your contribution timing. If your plan allows, understand when your contributions are invested. Some plans invest immediately, others batch contributions. Timing can matter during volatile periods. Additionally, ensure you're capturing any available employer match. The match represents immediate guaranteed return on your contribution. Not capturing the full match is leaving compensation on the table. Step 6. Review plan features. Many 401k plans offer features participants don't use. Loan provisions, hardship withdrawal rules, in-service distribution options, Roth 401k availability. Understanding available features enables better planning. You may never use these features, but knowing they exist affects your complete financial picture. What about scheduled economic events? Throughout each year, scheduled events can influence markets that affect your 401k. Federal Reserve decisions, employment reports, inflation data, earnings seasons. For long-term 401k investors, these events typically represent noise rather than signal. Attempting to time 401k allocations around scheduled events is generally not recommended and often counterproductive. The value in understanding these events isn't for timing purposes, it's for interpretation. When your account fluctuates following a Fed announcement, understanding why helps maintain perspective. Now I know what some of you are thinking. Let me address the counter-arguments directly. But I use target date funds. I don't need to understand this stuff. Target date funds provide convenience, not guarantee. They're based on assumptions about your situation that may or may not be accurate. They assume your only retirement assets are in this account. They assume their glide path matches your risk tolerance. They assume you'll retire at the target date. If any assumption is wrong, the default allocation may not serve you optimally. Understanding what your target date fund actually does enables assessment of whether it's appropriate for your specific situation, but I'm decades from retirement. This doesn't matter yet. Time horizon cuts both ways. Decades of runway means time to recover from volatility. It also means decades of fees compounding against you. A participant paying 1.5% higher fees than necessary for 40 years loses a significant percentage of potential retirement wealth to those excess fees. Understanding fees matters more, not less, when you have decades ahead. But I don't have time to manage my retirement account. Understanding doesn't require active management. It requires periodic review, perhaps quarterly or annually. A few hours per year to understand your largest financial asset seems reasonable. And understanding doesn't mean constant trading. It often means more confidence in maintaining your existing strategy because you understand why you chose it. But my employer chose the plan. I have no control. You have more control than you think. You choose how much to contribute. You choose among available investment options. You choose whether to use target date funds or build custom allocation. And you can provide feedback to HR about plan features. Employers do change plans based on participant input. But trying to time the market doesn't work. Correct. I'm not suggesting you time the market. I'm suggesting you understand your account. There's a vast difference between move to cash before every Fed meeting and understand how Fed decisions can affect markets so you maintain perspective during volatility. Understanding enables better behavior. It doesn't require timing. So what does this mean for you? Practically, specifically. Starting now. Again, I'm not a financial advisor. I'm not telling you what to do with your retirement account. These are questions to consider and potentially discuss with qualified professionals. First, log into your account this week. When did you last actually review your 401k? Not check the balance, but actually examine your holdings, fees, and features. Many participants haven't logged in for months or years. Start with basic awareness of your current situation. Second, calculate your total fee burden. Add plan administrative fees and fund expense ratios. Understand what you're paying annually. Compare to low-cost alternatives if available in your plan. If fees seem high, consider whether lower-cost options within your plan might be appropriate for your situation. Third, verify your allocation matches your intention. Are you as aggressive or conservative as you meant to be? Has drift changed your allocation from your original intent? If you've never consciously chosen an allocation, now is the time to make an intentional decision rather than accepting whatever default you received. Fourth, confirm you're capturing the full employer match. If your employer matches contributions, are you contributing enough to capture the full match? If not, consider whether increasing contributions to capture the match makes sense for your situation. Fifth, read your plan's summary document. Every 401k plan has a summary plan description. It describes features, rules, and options you may not know about. Reading it once provides understanding you'll have for the duration of your participation. Sixth, consider whether you need professional guidance. If this video raised questions you can't answer, that's valuable information. A qualified financial advisor can provide personalized guidance that no YouTube video can offer. The cost of professional advice is often worth paying when retirement security is at stake. If this analysis provided value, subscribe to The Silent Economy and hit the notification bell. I release new research weekly, and upcoming videos will explore specific aspects of retirement account dynamics in greater depth. Drop a comment below. Tell me what you discovered when you reviewed your 401k, what surprised you, what questions you still have. I read every comment. This channel grows through engaged discussion with viewers who want to understand their financial lives more deeply. Here's what I want you to remember. Your 401k likely represents your largest financial asset outside of home equity. Yet most participants couldn't accurately describe its fees, holdings, or features. The set it and forget it advice has value for avoiding emotional trading. But it shouldn't mean complete disengagement from understanding your own retirement savings. Economic events affect your 401k. Fees compound against you. Allocation choices matter. Your behavior during volatility matters. None of this requires becoming a financial expert. It requires periodic attention to an asset that will determine your retirement security. The information is available. The account is yours. The questions are worth asking. Thanks for watching The Silent Economy. And remember, the participants who build successful retirements aren't always those with the highest returns. They're the ones who understood their accounts, maintained appropriate behavior, and sought guidance when needed. Your 401k deserves your attention. The time to understand it is now.